All right, future CPAs, welcome. Look, we all know inventory is a beast of a topic, but before we even get into the crazy stuff like FIFO or LIFO, we've got to nail the absolute basics. And the most basic question is, what's the real cost of your inventory? That's what we're going to crack today, a crucial piece of your LCPA prep.
Okay, let's kick things off with a question. You buy some inventory, you get an invoice. Is that sticker price the number you slap onto your books? What do you think? If you're shaking your head no, you are absolutely right. That invoice price, that's just the starting line, not the finish.
You know, the easiest way to think about this is like ordering food online. I mean, we all do it, right? You see the price for the food, but that's never what you actually pay. You've got the delivery fee that gets tacked on, and then, fingers crossed, you've got a promo code to slash that price down. Inventory accounting is literally the same thing. The list price is just where we start. We've got our add-ons and our deductions to deal with. So here's our game plan. We're going to cover the official rule on cost. Then we'll look at what you have to add and what you have to subtract. After that, it's the main event, the showdown between the gross and net methods. You know this one's going to be on the exam. And we'll finish up with a quick review to make sure this all sticks. All right, first things first. Let's get the official rule down. What do the standards actually say cost even is?
Okay, don't just skim this. Zero in on that phrase, present location and condition. Seriously, this is your secret weapon. For any cost you're looking at, just ask yourself this one question. Did I have to spend this money to get the inventory here and get it ready to be sold? If the answer is yes, it's part of the cost. This little hack will get you through so many exam questions, I promise. So let's build this out. We'll start with the plus side of the equation, all the costs you have to add to the price tag. Right, so back to our shopping cart. The purchase price is in there. Then you've got shipping, which in accounting speak is freed in. If the stuff is coming from overseas, you've got import duties and any taxes you can't claim back. All these things go into the cart because, well, you need them to get the goods to your warehouse. And this is key. These costs are capitalized. They become part of the inventory's value on your balance sheet.
Okay, now for the best part, making the price go down. Let's talk about the stuff you get to subtract. So what are these magic price reducers? Well, you've got trade discounts. Maybe you get a special price just for being a regular customer. You've got volume rebates for when you buy a ton of stuff. And the big one for our discussion today, cash discounts for paying your supplier early. The rule is simple. All of these come off the top. They reduce the cost of your inventory, period.
And that last one, the cash discount, brings us to the main event. Seriously, you guys, pay attention here because this is classic LPCPA material. When your supplier says, hey, pay me early and I'll give you a discount, how do you actually record that? Turns out there are two ways to do it.
So you've got two schools of thought here. First is the gross method. This one's kind of pessimistic, you know? It just assumes you're going to be late and miss the discount, so you record the full price. Then you have the net method. This one's the optimist. It assumes you're on top of your game and you're definitely going to pay early, so you record the discounted price from day one.
Let's make this real with an example, just like you'd see on an exam. Imagine on July 1st, your company buys a whole lot of stuff. One batch for 4 million pesos, another for 5 million. The supplier gives you terms of 215 and 30. And we all know what that means, right? Pay within 15 days, you get a 2% discount. If not, the full amount is due in 30 days.
So here's how it plays out. The 4 million peso purchase, you pay for it on July 16th. Let's see, July 1st plus 15 days is July 16th. Perfect. You're inside the window, so you get the discount. Awesome. But that 5 million peso purchase, oof, you pay on July 31st. Way too late. You missed the boat on that discount. Now, this is where it all starts, the journal entry on day one. This is so important. Under the gross method, you just ignore the discount for now. You record the whole 9 million. Simple. But the net method, it's different. You assume you're going to get that 2% discount on everything. So 2% of 9 million is 180,000. You subtract that right away and record the purchase at 8.82 million. See the difference from the very start? Okay, so this is really the moment of truth. This is what separates the pros from the rookies. Paying on time and getting the discount is one thing. But what happens when you mess up and pay late? Especially, how does the net method handle it when you miss the discount you already assumed you were going to get? This is where it gets good.
And this brings us to a super important account that only exists in the net method. Purchase discounts lost. This isn't an inventory account. It's an expense account.
Think of it as the oops, we messed up account. Its entire job is to shine a spotlight on inefficiency. The money you lost by not paying on time, it doesn't get buried in the cost of inventory. Nope, it gets called out as an expense for everyone to see.
Now look at the journal entry for that late $5 million payment. Under gross, easy peasy. Your payable was $5 million, you pay $5 million cash, done. But under net, whoa. Remember, you only recorded the payable at $4.9 million, right? That's $5 million minus the 2% discount. But now you have to pay the full $5 million in cash. So where does that extra $100,000 go? Boom, that's your debit to purchase discounts lost. It's the penalty for not taking the discount you said you would. So let's tally it up. For the gross method, what's our final cost of purchases? Well, we started with $9 million. We successfully took a 2% discount on the $4 million payment, which is $80,000. So $9 million minus $80K gives us a final cost of $8,920,000. But now look at the net method. The cost of purchases, it stays at $8,820,000, exactly what we recorded on day one. It never changes. But wait, you might say, what about the missed discount? Remember that $100,000 we lost is not a cost of inventory. It's an other expense on the income statement. This is the whole point. The two methods give you a different cost of inventory and a different net income.
Okay, deep breath. That was the heavy lifting. Now let's lock it all in with a quick bullet review. This is your ultimate cheat sheet for this topic, so get ready to screenshot this.
Okay, here are the non-negotiables. 1. Your basic formula is purchase price plus freight in minus trade discounts. 2. Always use the present location and condition test. If it wasn't needed to get the item to you and ready for sale, it's not a cost of inventory. 3. Selling and admin costs, always an expense, never inventory. 4. Gross method uses a purchase discounts account. That's a credit. Net method uses purchase discounts lost. That's a debit expense. And finally, why does this matter? Because the method you choose changes your inventory value and your cost of goods sold. It's a big deal.
So I'll leave you with this final thought. Most of the theory geeks out there say the net method is just better. Why? Because it shows the true cost of the asset, what you should have paid, and it calls out any inefficiency, any missed discounts as a separate expense. It paints a more faithful picture of what's really going on. So what do you think? Getting the why behind the rules isn't just extra credit, it's the best study hack there is. It's what makes the how stick in your brain on exam day. You've got this. Good luck with your studies.